the mortgage REIT trade. And we've had a number of companies that really focused in mortgage REITs as opposed to being a real estate investment trust that focuses in mortgage REITs as just one component and then others for other types of real estate. For the pure mortgage REITs, that trade, that investment, it does not look to be very optimistic going forward. And there are two reasons for that. The first is that so if you go back to the early 1980s when we had rapid inflation, the Federal Reserve brought interest rates way, way up to slow down that inflation. So they brought them up into like the 18 to 20% range, even for really short-term rates. And then ever since then, interest rates have been going down. Well, one of the consequences of falling interest rates are that on the other side of that, the value of fixed income investments, which mortgage-backed securities are a fixed income investment, the value of those increases as interest rates go down. So, you have like, let's say, Analyst Capital Management or American Capital Agency. You have these companies that are sitting on these, tens of billions of dollars worth of mortgage-backed securities, i.e. fixed income securities, as these interest rates have been coming down. So those values have just consistently been going up over the years. Well, interest rates are now plateauing around the 0% rate, right? So you can't look at a mortgage REIT's past and look into the future and think like, oh, like that's what their business is going to look like in the future, because interest rates we're just not going to see those short-term interest rates go up to 20% again anytime soon. I mean, it's hard to envision a scenario under which that would be the case. So you're going to have that benefit coming away from the mortgage REIT. And the other benefit that you have coming away from the mortgage REIT is that where they really, really made a ton of money over the past couple decades, and they've done well over the past couple decades, but where they really, really killed it was during the financial crisis when the Federal Reserve dropped interest rates to near 0% relatively quickly, but the longer-term interest rates took longer to adjust downwards. So that spread was really wide for a time period, and that's why a company like Analyst Capital Management was so popular and did so well during the financial crisis. Well, now, again, you have interest rates, both long and short-term interest rates, compressed right above 0%. So you're just not going to have the size of the spread. It was literally a once in multiple generations type of thing that made mortgage REITs so profitable over the past couple decades. That, in my opinion, is now gone.
Absolutely. I don't know if listeners out there are wondering where the long-term interest rates are set. Those kind of follow the short-term interest rates. It just takes them longer to adjust because they're obviously long-term. So say you bought a house pre-financial crisis, you probably had a mortgage with a pretty high rate. That's why a lot of people ended up having to default during the financial crisis. Now that has evened out. You can buy a house with significantly lower interest rates on your loans now than you could before.
Yeah, I mean, you could get here. To put this in, anybody who's thinking about buying a house, keep this in perspective. Over the last 30 years, the average interest rate on a conventional 30-year mortgage has been something like 8.5%. Right now, I don't know exactly what it is, but right now it's something like 3.8%. I mean,
yeah,
you're looking
low.
at historically low interest rates. And then when you factor into the equation that eventually, presumably, you'll have some inflation come back into the equation. So that will work against that. So let's say we get 2% inflation and you're paying 3.8% in your mortgage. You're basically paying 1.8% to borrow money. I mean, it's just ridiculously cheap right now.
Yeah. So, I mean, we should probably talk a little bit about what mREITs are going to do in the future. The one that comes to mind is probably Analyst Capital. They were kind of the first, and they're still the biggest mREIT out there. But what you're seeing in order to cushion themselves for what they know is probably going to be a lean season for them, is that they're starting to move over into commercial real estate.
Right. Yeah. And so here's basically like, this is the dominant player in the industry that a couple years ago has started to diversify away from that pure mortgage REIT business model that did so well for it for so long. If that shouldn't be a sign to investors, then I don't know what is. You know what I mean?
Yeah, it's kind of how in the tech industry, when Apple does something, everyone kind of looks to it and says, you know what, like maybe we should start thinking about doing that too.
Yeah, and let me be clear. There are a lot of people who go around and think that Analyst Capital Management's management is, so brilliant because they've done so well over the decades. I have a tendency to think that they were just there at the right, they were just, in the right place at the right time. It was more luck than anything else is what's kind of behind their success. But that being said, they are the industry leader. So if you want to kind of, divine the future of the industry and the kind of the trends that we're going to see going forward, Annaly is certainly at the cutting edge.
Absolutely. Okay, that's pretty much all the time we have. So before we wrap up, I want to let everyone know that as part of Dividend Week, we've put up a free webpage that has a selection of dividend stocks that the contributors of Industry Focus are interested in. It is at dividends.fool.com. So go take a look. Again, that's dividends, plural, with an s.fool.com. I was told to really enunciate the word dividends with an S, so I hope you all got that.